Good afternoon, ladies and gentlemen. Thank you for joining us in this wonderful Saturday afternoon. I'm very honored to be here today moderating this exciting panel discussion with our distinguished experts from top asset management companies here. Please feel free to post your questions to our experts, and if you have any specific panelists you would like to answer your question, you can also mention their names here. Without further ado, let's kickstart the highly anticipated session with a blast from the past. Looking back into 2021, what were some of the key takeaways for you, Jerry?
Good afternoon, Jason. Good afternoon, everyone. Lessons from 2021. I suppose one lasting lesson, is treat your staff right. I think a few Malaysian companies fell a bit foul of what they call modern slavery charges, and it doesn't matter if they're justified or not justified. Once you get into that, as far as a lot of institutional investors, particularly foreign ones, are concerned, the best thing to do is avoid. Our portfolio last year did quite well, I think. We have our standard high conviction plays that we hold for the very long term, and they pay out a fairly decent dividend, but we were overweight our growth stocks, really, in the electronics manufacturing sector in particular. We did rather well, and we weren't really worried about dividends. We were more worried about whether these companies were exposed to growth areas in the world. And that's one of the key lessons we learned last year, I think, that we were slightly overweight these growth companies, which probably didn't pay out dividends at all. This year, I think, might be very different. I don't know whether that's the latter point I made is a lesson that you could take through till 2022.
Thanks, Jerry. How about you, Robin? Do you have any key takeaways from 2021?
Thanks, Jason, and thanks for inviting me on this panel to give my opinions. I think the key takeaway for me for 2021, I'm just not really talking about markets, but is the resilience of people, right? And the adaptability, because with COVID, even though, many countries did not handle it well in general, we're out of it now, right? And people are going back, even though we can't do a conference. I'm on this call doing it with all of you now, and I have to say, is the resilience of society, resilience of markets, in spite of really difficult situations, and that's the lesson to be learned. I would say that even though there are ups and downs, we are adaptable, right? And somehow, people will find a way to overcome the obstacles we've seen, right? So that's my takeaway for 2021.
Yeah, I totally agree with you. In fact, our key investment theme for this year, 2022, is called "The Show Must Go On," which is pretty much what you mentioned just now.
Yeah.
Let's move on to Gan Leong. Do you have anything to add on?
Yeah, so basically, I think in 2021, we were overly optimistic that we can get past COVID, everyone can start traveling again, going back to work. But then, over time, we start to see that, the virus continue to evolve, and, from Alpha to Delta to now Omicron, eventually we'll probably run out of Greek letters, alphabets. So from what we see is, everything is constantly evolving. Now, of course, the biggest fear for us right now is whether this Omicron variant will, the next variant that comes up, will it be a bit more lethal than what we see today? At least for the Omicron variant that we see today, it's highly transmissive, but it's not that lethal. So in a way, it actually, if you think about it, there's light at the end of the tunnel, because in a way that a lot of people, the anti-vax people will be, in a way, be able to actually achieve natural immunity by getting infected with Omicron. Because it's very transmissive. So, and also on the bright side is hospitalization rates are not actually spiking, it's coming down. You look at America, one of the hotspots in New York, your hospitalization rates are coming down. So we think that, hopefully this is the year that we can, get back, to what we are used to start to travel again. Services can open again, and I suppose what we learned last year is that things are constantly evolving. So especially it's like the financial markets nothing's ever static.
Okay, let's stay with Gan Leong. You mentioned about looking forward into 2022. What are your top investment ideas for 2022?
Okay, so basically right now, I think at the start of last year, I was actually quite positive on these reopening trades. I'm very bullish on the tourism and leisure sector. So, but because of the Omicron variant, the Delta variants, people's initially borders were supposed to reopen, but again, because of these new variants, the new outbreaks, that have been put on stop at this point of time. But I am still bullish because I've seen that a lot of these stocks are still trading at 30 to 40% below its pre-COVID levels. So I do see a lot of opportunities in this space. So I do like the tourism and leisure sector. I do believe that the services sector will come back strongly. Of course, the biggest fear I see is inflation in the service sector. Right now, we are seeing inflation in the consumer side, on the consumption end, because people are just buying gadgets, buying furniture, buying stuff for their houses, because they cannot spend it anywhere. That's why your designer handbags, your luxury watches, the prices are just spiking up. So from our standpoint, is what we fear is this inflation that we see in private consumption may trickle down to the service sector, which is why we are actually quite bullish on the tourism and leisure sector, because I do believe that this sector will eventually do well.
Thanks for that. Next, let's move on to Jerry. I'm pretty sure our listeners would also like to hear Aberdeen's top investment ideas.
Right. Well, I don't run the equity desk anymore. I just represent Aberdeen. So it's a little a black box that's driven by my equity team. But as I said, last year we did quite well by being overexposed to growth stocks. This year, I think, is going to be far more dangerous and far more risky. And we don't have in the world the tailwinds that we've had in the past. And in the last year for the world and even for Malaysia, I think people were looking for return on capital. They were looking for getting returns on their investment. I think you need to be a bit more careful this year of the return of your capital. You've got to make sure that you preserve capital and your risk management has got to be a lot more rajin, I think, than it has been, because we're going into some huge tailwinds. If the US Federal Reserve, the Bank of England, to some extent the European Central Bank, or the Bank of Japan are anything to go by, they seem to be saying, the party's over. We need to tighten monetary policies. We need to raise interest rates. The tailwinds that we've had from central banks has been massive. In 2021, we ended up the year with this massive stimulus, mainly in the developed markets. I must admit, they were getting helicopter money into people's pockets. Trillions and trillions of dollars and pounds were being given to consumers, and they spent it. And this leads to huge surge in growth. So much so that there's not the capacity to meet a lot of the demand, which caused this inflationary problem. But I think maybe the inflationary factors might be waning a little bit. In the US, I think the print in December was 7%. I think there are signs that maybe that number has probably peaked. It depends how far down it will go. But I think this year, we are looking at more of our high conviction plays with strong balance sheets, good cash flows. And I agree with Gan Leong that who knows? We don't know what's going to happen, but I spent a few weeks during Christmas in the UK, and my arrival on the 15th of December saw 40,000 new cases of COVID. When I left on the 3rd of January, it was 145,000 new cases of COVID every day. But in Malaysia, it's fallen to what, 3,000 or 4,000 every day. We seem to have handled it very well. Malaysians seem to be a good deal more responsible. My Sejahtera and checking into every retail outlet, every office using My Sejahtera would not be possible elsewhere. But it has paid off, and it's the benefits. Let's say after Chinese New Year, if cases don't go up markedly, I think there will be an opening out of the economy, and I think it does mean good things for the leisure sector. But I think people will be wanting to borrow money a bit, and interest rates aren't going to shoot up like they might do elsewhere. You know, banks are the best exposure to a pickup in domestic activity. So I think banks are a good sector to be based in at the moment.
Thanks, Jerry. Back to you, Robin. Can you share some of Maybank Asset Management's top investment ideas?
Yeah, thanks, Jason. Yeah, I echo what Jerry says. You know, there's going to be a big shift in 2022. And actually, what we think is quite contrarian. Actually, we think that in 2022, Asia will start outperforming the developed markets, right? Last year, of course, US did really well, as Jerry pointed out, tons of stimulus pushing up markets. Well, actually, for 2022, it's a reverse. The Chinese authorities are loosening, right? They are providing the tailwinds to the Chinese markets. And that would, I would say, pull up the rest of the Asian markets like Malaysia and Indonesia, right? Whereas in the developed world, we are seeing the US and UK tighten by, cutting stimulus and raising interest rates. So what we're going to see in 2022 is Asia would start outperforming the developed world. Now within Asia, I know there's a bit of skepticism of it, like in Malaysia, didn't do so well last year, but we think in 2022, with a smoother reopening, people are going back to the bars and restaurants and shopping again. That would boost the economy, and I would say in general, probably Malaysia would do well. Indonesia, of course, is a country which has kind of changed because there's a lot of FDI now going to Indonesia for the EV space. So I think they are big beneficiaries of this trend, and that would boost Indonesia in 2022. So really, the message is that Asian assets look attractive now because there's tailwinds from China, whereas for the developed world, I think you see a lot of headwinds going forward.
Yeah, staying with you, Robin, you mentioned that you are bullish in Asia, China, Malaysia, Indonesia. Now, we all know that investments, they come with risks. What are the potential headwinds or risks that you see which could derail this bullish sentiment that you mentioned?
Yeah, I think Gan Leong pointed out some of the risks already. I mean, stuff like, new variant of COVID, right, which of course nobody knows. The other thing, which probably is very, very important, is inflation, right? So Jerry mentioned that maybe inflation is peaking. However, if it doesn't peak and continues going up, then I think it's a really, really big risk for markets, because we've already seen in maybe even the first 2-3 weeks of the year when inflation expectations went up, you've seen the US markets correct. Now, if inflation stays really sticky, rates may have to go up further, right? The expectation rates will have to go up further, and then they're going to see further corrections. But I think as of now, we don't expect that. We expect inflation to be peaking. And really, back to what Jerry said, a lot of people in 2021 were buying a lot of stuff because they were stuck at home. So ordered a lot of stuff online, and that's why you're seeing a lot of jam ups at the ports. Supply chain, it's a kind of like a traffic jam over there, and that has pushed prices up. But of course, in 2022, that would diminish, right? Because people are going to go out to spend more on services, go out traveling, like Gan Leong mentioned, do a little bit of travel, go out to F&B and buy less stuff. When you buy less stuff, well, the supply chains problems will ease. And therefore, I would say inflation should be peaking at least in the first quarter or first half of 2022. So we don't think rates are going to surge, 6 rate hikes. I think it's a little bit too much for me. Yeah. Back to you, Jason.
Thanks, Robin. So based on what you said, it seems like the risk and the reward ratio is still quite attractive. The risk is still manageable to a certain extent, whereas the upside potential is too attractive to ignore. How about Gan Leong? Do you have any additional risk that you would like to add on?
I think I share the same concern with Robin. I think everyone is talking about inflation. Inflation is the one that could get out of hand. I do agree that, with the Fed share that eventually inflation is transitory. It will slowly come down as, people buy less things. But I would say that the biggest risk I see today with that view is China, actually. It's actually revolving around China because of China's zero COVID policy. So the thing is, Omicron, again, is highly transmissive. It's not so easy to contain. And if China doubles down on that zero COVID policy, that will actually add more strain to the current supply chain issues that we see today. It doesn't take, all it takes is a few port closures, few manufacturing closures, because in the world that we live in today, the globalization, everything's integrated. So you can have all the parts in the car, of a particular car ready, but all you need is just a couple of essential screws from that particular region in China to being shut down, or due to COVID. Then it will really put a strain on the whole supply chain. So our biggest fear would be that whether China will start to loosen up on the zero COVID policy, because if they don't, based on how viruses evolve, the next variant could very well be even more transmissive than the Omicron variant. So that would be my biggest fear, because if the supply chains constraint there, inflation pressures could pile up, and then that will lead to the Federal Reserve reacting aggressively by raising interest rate too quickly. That's our biggest fear.
Okay, moving on to Jerry. Just now you mentioned about central banks as well. Do you have anything additional to add in terms of what are the risks that could trigger some central bank policy changes that would actually derail this positive sentiment in the market?
Apologies, I was muted. Speaking globally, and I don't put Malaysia, put it with the developed world in this, but we have had the hell of a party in the world. We've had quantitative easing and 4 attempts at removing it since the global financial crisis of 2008. We've had interest rates at 0, and any attempts to raise them over the past, goodness me, it's nearly 14 years, have been ineffective. But this quantitative easing, QE4 is twice the size of QE1 and QE2 put together. It's 50% larger than QE3. In the developed world, you've also had massive fiscal stimulus to try and, if the government tells you to go home and do nothing, you're sort of going to break the economy. And if you break it, you've got to pay for it. And they've paid for it by, siphoning all this money to individuals. That's over. I really think that if they carry on with their sort of hawkish talk and start to walk that talk, the world is going to see a huge difference. That's a big risk. But I would add that, as Robin said, the price earnings ratio and the price to book for Asia, and I'd say in particular Malaysia, is so out of kilter with the ridiculously inflated valuations of the developed world. I think that it makes sense, if you want to get a proper return, to increase weighting in Malaysia. And at the moment, foreigners, don't really have anything in Malaysia. I think we're down at what, 20.4% foreign ownership in the market, and a lot of that is BAT, UK owning BAT shares, RJ Reynolds, Panasonic, etc., etc. So I think we might at last be beneficiaries of that.
Yeah, staying with Jerry, given that you mentioned these investment ideas and also the risk, well, I'm pretty sure our listeners will also like to hear how you're positioning your portfolios in 2022. Are you increasing, like you mentioned, you like Malaysia, are you increasing allocation into Malaysia for your portfolios?
Globally, Malaysia's been either neutral or maybe slightly underweight in our global funds because of liquidity, really. If you're running a global fund, and you're running a big fund, maybe there aren't many stocks in Malaysia that are that liquid, and those that are might not be ones that blow our skirts up very much. Regionally, I think we've been neutral to overweight Malaysia, but I think, you know, the themes that we might be looking at as a whole and as a group are not any different from others. I mean, there is a digital future out there, and I think Malaysia is actually quite switched on to things changing. And there are a number of ways in which you can invest in new ways of doing business. You know, traditional retail seems to be dying a death, but there are other areas for replacement. I think Malaysia is still benefiting from urbanization and concentrating on people moving into the cities. And there are various, well, I suppose in simple terms, property developers that might benefit from that. And I think Malaysia is just about the only place in Asia, let alone the world, where property prices are doing absolutely nothing at the moment in the residential front. So, you know, I know there is a bit of an overhang, but there are areas where there is a shortage. And if people start to increase their economic activity, as touch wood, inshallah, COVID starts to die a death, then I think we'll see the property market pick up. And then, of course, reopening plays, you know, airports. I was at KLIA 2 weeks ago. What a depressing place. There's nothing going on there. But if that starts to pick up, all the services related to it will start to benefit as well. And everybody talks about the risks of climate change. There are also huge opportunities. You know, 3.1 billion US dollars to be spent, or trillion US dollars to be spent annually between now and 2050 globally for, you know, converting and transitioning to a carbon neutral world. There are many stocks in the power generation sector, the automotive sector, in which people can benefit.
Thanks, Jerry. Let's move back to Robin. So just now you mentioned that you liked Asia compared to developed markets, and also you mentioned some of the risks. How are your portfolios positioned in light of this information that you mentioned just now?
Right. I think in general, what we will be doing is because we are a little bit more positive on equity. So if you look at the balance fund, let's say it's 50-50, then we'll be tilting slightly into equities because of, you know, in the first quarter, the first half, rates are going up. So maybe you do more equities to fixed income. So maybe a 60-40. But within that, I would say you would probably want to be more overweight Asia compared to, you know, the developed world. And now I would say ASEAN is a place we like. I mean, China, well, I mean, there's still some issues, but we'll probably rebound from next year. So we also kind of like China as well. So really, those are the areas where we like. In terms of sector, I just wanted to point out that, yes, the renewable sector, as Jerry has mentioned, it's a big boom there. And what people don't really know is China actually provides a lot of the renewable space infrastructure, right? So if you look at batteries, they are one of the dominant players in that. They also do the inverters. They do a lot of the wind products, the turbines and such. So I think people have done studies. They encompass maybe 60% of the growth in the renewable space. And if you look at China market, the auto market, even last year, they sold 30% of the total new cars sold were in the EV space, right? So even in Malaysia, we are a little bit behind. And only now there's been some incentives for people to buy EV cars. You know, there's no tax on them. But, you know, China's, I think I would say they're ahead of the world, because now about 20 to 30% of new cars sold are actually EV cars, right? So that's one area where China is leading, and I would say they'll be leading the rest of the world into this. So those are the areas where I like, and I'd like to hand back to Jason.
Thanks. Finally, Gan Leong, how are you positioning your portfolios for 2022?
Okay, within Malaysia itself, we are actually building our position in commodity plays, because in a rising interest rate environment, especially in the early stage, right, usually historically commodities tend to do well. And of course, if the inflation do persist, we are obviously it's going to really help the commodity players. So why we like this commodity space, particularly in Malaysia, we actually turning a lot more bullish on energy stocks. I think last year, KL energy index was down about 20%. When compared to other countries or other regions' energy index, I think America, surprisingly, the best performing index in America last year wasn't tech. It was actually its energy index. And then if you look at from emerging markets itself, the emerging market energy index was up about 20% last year. Whereas, our KL energy index, our Malaysian oil and gas stocks were lagging behind by not a bit, by a substantial amount. You're talking about, 40% performance disparity between the Malaysian oil and gas players with the emerging market oil and gas players. And we're talking about close to 80% with the Malaysian oil and gas players with the American oil and gas players. Despite crude oil going up significantly last year to now, it's I think $80 over. So this is one area we are quite bullish on. If you zoom in further from a micro sector perspective, we do like the oil and gas pipe players, people who provide pipes. If you look at the Petronas 2022 outlook, you can see that there's a significant increase in the requirement for carbon steel pipes. We're talking about 8 times increase from 2021. And then if you look at the man hours required from 2022 compared to 2021, we saw significant increase as well in that area. So, your oil and gas service providers should start to see benefits or at least more jobs trickling down. And then, of course, we have to be very selective because we do know that Petronas have a tendency to, renegotiate contracts, renegotiate lower prices. So what we look for is we look for players that do not rely just on Petronas. So in that sense, the 2 oil and gas pipe players that we have invested in, they are global players. They do export. They do not rely on just Petronas. They supply to Halliburton's. They supply to the regional players. So in that sense, Petronas has less leverage on them. So this is one particular area that we are actually bullish of at this point of time. And we do think that the disparity will narrow this year.
Thanks, Daniel. We do have some very interesting questions from the listeners, from the crowd. For example, what advice do our panelist experts have to give investors about risk management? How would you advise them to, what kind of strategies can you help investors to implement going forward in 2022 in terms of risk management? Perhaps we can start with Gan Leong.
Okay, so basically from our standpoint is, again, we have to look at your risk profile. I mean, if you're older, you do have to set aside, some funds for, investing in fixed income and money markets, like a balanced approach, actually, maybe a 60-40, 70-30 approach where you have 60% equities. In the sense that because there will always be volatility within the equity markets, and if you require income from this particular source of investment, then it's not wise or prudent to actually invest all in equities, because there will be volatility and you do not want to sell out during down markets, and I find it very difficult to time the markets. You cannot say that, or maybe I invest right now, I only need the money 6 months later, but a lot of things can happen within the 6-month time frame. So I do believe that take a balanced approach, only invest in money that you can afford to lose, or at least afford to set aside for the next 3 years in equities, because there will be risk there. Just take a balanced approach, and you need to manage your greed. There's no such thing as easy and fast money.
Thanks, Daniel. How about Jerry? Do you have any useful risk management strategies that retail investors can implement in their portfolios?
Well, as I say, 2022 is very different from 2021, and I've got a quote here from a guy called Charles Brown. Winning in the investment game means not losing. I don't know if you heard a guy called Jim Rogers. He's a very successful billionaire investor, but he said the trick in investing is not to lose money. If you compound your money at 9% per annum, you're better off than investors whose results jump around. The losses will kill you because they will ruin the compounding qualities. And compounding is the magic of investing. I mean, I can't highlight enough how, you know, when I first started in broking, it was all about growth and trying to sell ideas about sexy stocks to people. And there was this old timer I worked with who said, you know, if you buy a share and you hold it, what do you get from it? The answer is absolutely nothing until you sell it, but unless it's a dividend. And I think, you know, dividends are very important. And as Ganyong said, the 60-40 trade, or mixing bonds with equities, has been right out of fashion. You know, people think bonds are a waste of time with interest rates at zero and everybody chasing yield. The yield of what we get for 10-year treasury, 1.6, 1.7%. That's if you're looking for return. The market is now just looking for return of capital or safety. And that's really the philosophy upon which people would invest in fixed income instruments. And I think that you should have some of your money, apart from being in gold and Bitcoin, in fixed income instruments, because they do give you something. So, and the other thing I would just sort of put a word in is that everybody globally, you know, we've had this ESG growing, people increasingly aware of climate change, increasingly aware of basically modern slavery and good governance. And the plantation sector has been a victim. You know, every kid in Europe thinks that palm oil equals dead orang-utans. Well, I've read a few ESG research recently from some quite well-known global brokers who are actually now recommending specific palm oil stocks because they are properly managed, they are sustainable, and the lack of sustainability is really more from the soybean oil manufacturers, planters in Amazonian rainforest. The rapeseed oil business in Europe is massively government subsidized. The most efficient producer of edible oil is palm oil. And I think if they can improve their credibility, and there have been a few statements about shooting orangutans before they shoot you, which doesn't help matters, but I do think the palm oil sector, if you pick the right stock, will continue to do well.
Thanks, Jerry. Finally, Robin, do you have any risk management strategies?
I think the most important risk management for retail investors is diversification, right? I mean, you don't put all your eggs in one basket, because for most retail investors, one, you do not have the time to analyze the company so thoroughly, right? Number two, you may not have the time to trade so frequently to get out of stocks which may no longer be doing well. So I would say the biggest lesson for retail investors, of course, is to at least practice some diversification. Maybe not just stocks, maybe with regions as well, right? And I would say also, to echo what Jerry says, you know, have some bonds as well. And if you look at the Malaysian market, to be honest, at least for Malaysia, rates are higher, right? Your 10-year ringgit rates are closer to 4%, which is quite decent in this environment. Yep. Of you know, maybe a growth scare in the developed world, and you know, it's far higher than the US 10-year, which is only about 1.7, 1.8. So what I was just thinking is that if you look at Malaysian rates, quite attractive, because even though rates are going up, the Malaysian rates are already closer to pre-COVID levels, right? They're already almost at 4, which was what it was 2 years ago. So I would say it is probably more resilient in the face of the US interest rate hikes. And I would say that, you know, if you're a person who's maybe a retiree and such, then maybe you should have a little bit more allocation into the bond space, especially the Malaysian side, because, you know, you're still getting in about 4+%, right? Which is not, 4%, which is not too bad.
Now, one more thing, if I may, just by in favoring diversification, is that everybody at the moment now thinks that, speaking globally, interest rates are going up. The Federal Reserve have made no secret of that. I think the market seems to be baking in 4 hikes this year, maybe more. And that is what the Federal Reserve has been saying. But it's not called QE4 for nothing. And that they've tried this 4 times or 3 times already, okay, and they failed. So I don't think they'll be able to do it. There were times when central bankers were meanies, and I think somebody called Henry Kaufman described a central banker of the 1980s as somebody who learned his training by pulling the legs off ants. You know, they loved to cause misery amongst investors. Those days seem to be gone. They're all sort of super nice now, and they are under so much pressure from the government. In the US, for example, I think Joe Biden has to, there's some sort of midterm elections happening at the end of this year. You can't be raising rates, taking away quantitative easing into these sort of conditions. So I think they'll roll over. So when I say this supports diversification, don't sell all your growth stocks, because I think over 10 years, those stocks that have, got clear competitive advantage and are basically highlighting the speed at which things are changing in technology, in terms of online communication, financial transactions, etc. You still should keep some, even though they may be outrageously expensive, because I think the Federal Reserve will change its mind, and by this time next year, we'll be just where we are now.
That's a bold call, Jerry. Let's see how it goes.
Yeah, you can't delete that, can you? That can't be edited.
Okay, moving on, there's a question about the RCEP, the Regional Comprehensive Economic Partnership, which would create the biggest trading bloc in the world. Do you have any opinion, like will it be a key driver or key catalyst for markets going forward? What markets will be the key beneficiaries, or which sectors will be the key beneficiaries? Perhaps Robin could chip in first.
Yeah, I mean, the RCEP, I won't say it's like a huge catalyst, right? But it's a continuation of globalization, which generally is good for markets, because it provides the supplier and the person who buys lower cost products, right? I mean, and that's been seen in the scope of the 30 years of globalization, which we've seen. Of course, the RCEP, I would say it's also a way where, if you look at it, a lot of it are Asian countries are involved, right? And what we are seeing is that in the past, globalization was between the East and the West, right? China becomes the factory of the world, exports everything to the US and Europe. Now it's a little bit different. Now there's probably still a trade war between the US and China. And what you've seen, if you look at it, is more integration between China and Asia, right? We're trading more between each Asian country, right? So now even the biggest trade partner in Malaysia is China, right? And we are going to see more and more of that as we build greater links. So we're already seeing that in Malaysia, because in the past, when you did your KLIA link, the rail link, it was German rail, right? Siemens and all that stuff. Now, well, we're using Chinese products. Why? Because it's cheaper and just as good, right? Maybe it's half the price, but just as good. So we're going to see more and more of this. And it's just natural, because by trading more, everybody benefits, right? We are getting lower cost things, good prices, more trade, people's lives benefit. The only thing I would say which was bad for globalization is when there are some losers, of course, and losers were those who are unable to come up with value, and they were, their jobs were outsourced maybe to China and such. So governments would need to address the crowd, the people who have been left out now of globalization. And unfortunately, in the West, I don't think they've done a good job in helping those people who unfortunately were left out from globalization. Yeah, so but RCEP is a longer term thing, right? So I would say there's just more trade between trade partners in Asia, and I think that's generally good for everyone.
Thanks. How about Gan Leong? Do you think the RCEP will help Malaysia?
From my standpoint is, of course, I do believe that, I agree with Robin. There are already trade agreements between countries in the ASEAN region, Malaysia with China. I would say that the biggest issue here is actually being able to fulfill orders. Like Jerry mentioned earlier, right now, the problems that most companies in Malaysia face today is getting the workers, getting foreign labor, to do the jobs, to get the orders done. So until our government is able to address that issue, I understand that the government is trying to, restrict foreign workers from coming in, so that they can, boost the employments within the locals, help increase the wages. But problem here is there are just a lot of these jobs that locals do not want to do. Locals do not want to work in construction sites. When they want to apply to work in construction companies, they want to work in the office. They do not want to get on the ground and do the actual work, or they do not want to be in the factory floors, doing the, actual tedious work. They want to be in the office, doing administrative work. So problem here is not so much, that you don't allow workers in, then the local workers will, eventually do this job and fill up these jobs. It just doesn't work that way. So I do believe that, the biggest issue that our country need to address is, getting these corporates, local companies, the required help that they need so that they can fulfill orders. There's no point, getting more orders right now when you don't even have the workforce to fulfill it.
Okay, thanks. We have time for one last question, which I would like to direct to Jerry. It's because you talked a lot about central banks and stimulus and quantitative easing just now. A lot of our investors are concerned about the upcoming tapering of quantitative easing. Does it concern you, or is it will it become a potential black swan event, such as what happened in before, like the taper tantrums?
Yeah, I think there will be, well, we seem to be going through a bit of a taper tantrum right now, or paring back risk, because so many people have borrowed money to invest in the market. I remember reading somewhere in the US that something like 40% of loans made this year in the US were collateralized against shares. So if you gear up, there's one bit of advice I would offer to people is don't gear up and buy shares or buy any investment that involves a bit of risk. So the taper tantrum affects the developed world far more than it would affect us. We haven't got anything to taper from, right or wrong. When COVID came here and the economy shut down and we all went to home, the government didn't have the funds because of a few other foreign debt problems we've had over the past couple of years to TT money too much to individuals' accounts. But we allowed people to access the Employees Provident Fund savings to tide them through. And we've come out the other side with, in some cases, some very worryingly low savings for people's retirement. But I don't think we're going to suffer some hangover here domestically from taking away all the alcohol that's been provided to the punch bowl elsewhere. And I would say, they're going to try and do that again in the US. I don't think the Europeans have said that they are going to do it. I think the Bank of England said they are going to do it. Bank of Japan hasn't been buying so many assets, but they control vast quantities of the equity, bond, and ETF, particularly Japan government bond market there. Really, investing for the past few years has been doing what the government does and don't try and fight it. Well, if they try and get out of your face, then you've got to be a lot more careful about what you invest in. I've got a colleague who runs a hedge fund called Pangolin here, and he just said in his latest monthly, he said, inflation, deflation, the Fed, interest rates, geopolitics, politics, GDP, technical analysis, globalization, protectionism, Xi Jinping, Biden, Omicron, Evergrande, Boris Johnson, the preponderance of the majority of people to buy or not to buy shares in companies for reasons other than what the company is actually worth is what has given investing legends the opportunity to make their futures. It's not about being particularly clever. It's just about ignoring all the above rubbish. Valuations are what it's really all about over the long term. So you've got to, valuations matter now, whereas last year I don't think they did.
Thanks, Jerry. I think that's all the time we have for this session. I believe our investors are like me, they have grown wiser after this very useful and very interesting session. So now I'll pass on to the MC again. Thank you.
Thank you so much, Jason. Okay, it was such a wonderful interactive session today. Let us thank Mr. Gerald, Mr. Tan, and Mr. Robin once again for their insightful explanation, and we hope our audiences do grab some great knowledge throughout the session. Okay, and also thank you, Jason, for helping out, and I shall take the floor over for now.